Good afternoon and welcome to all joining us on Facebook Live and on YouTube. My name is Danny Kuan and I'm Dean of the Lee Kuan Yew School of Public Policy. It is my pleasure this afternoon to get to be your moderator at this, the inaugural lecture of my friend and colleague, Professor Ramkishen Rajan. Professor Rajan was appointed Yong Professor in February 2020. Because of the COVID-19 pandemic, we have held over this inaugural lecture until now. At the Lee Kuan Yew School of Public Policy, the Yong Professorship is a special one indeed. Yong in the words of PM Lee, was one of Singapore's finest sons. Yong was a lawyer and former Chief Justice in Singapore, and the son of Yong Shuk Lin, yet another lawyer whose name, of course, graces the law firm Shuk Lin and Bok. Mr. Yong was, however, not just a lawyer. He was also a champion of education. He was a university chancellor and a former banker who helped set up Singapore's Sovereign Wealth Fund, GIC, and served as managing director both at GIC and at the Monetary Authority of Singapore. Yong combined that financial expertise and acumen with one of the finest legal minds anywhere, for he was also Singapore's Chief Justice from 1990 to 2006. In one fell swoop, reforming Singapore's legal system towards a ruthless modern efficiency, and at the same time clearing a backlog of over 2,000 cases within a decade. Today, the Yong Professor Kishan Rajan brings to our school the same focus and sharpness of vision. He brings to our school the same efficient operation and effective delivery, together with a profound understanding and research in modern international financial systems. The fit is an excellent one between the new holder of the Yong Professorship and the vision and the work of the professorship's namesake. So I am delighted indeed that Kishan this afternoon delivers his Yong Professor inaugural lecture. It is on international finance, globalization of goods and services, the ever-increasing ease with which everything has become available to more and more people at lower and lower costs. That globalization has seen considerable discussion, not least on both its progress and on its incipient withdrawal. Financial globalization, complex and multidimensional that it is, has attracted arguably less popular attention. Indeed, while globalization, populism, industrial development might be thought of as going hand in hand in a slow-burning kind of way in all our global conversation, financial globalization often makes the headlines spectacularly and only when there is financial crisis and emergency. There's, of course, a lot more to financial globalization. For all these and many other reasons, I look forward with great anticipation now to Kishan's lecture, The Complexities of Financial Globalization. As he goes on, I hope that you will all input questions and comments onto the Facebook live stream. We will try and get to as many of them in the Q&A session afterwards. It only remains for me to bring onto the stage my good friend Kishan Rajan to deliver his lecture. Kishan, over to you, please.
Thank you, Danny, for those kind words. I should add, when I was a student in Singapore at the National Junior College and at NUS, I used to read collected works of some of the political leaders, Dr. Gokeng Sui, S. Rajaratnam, etc. And so it's a great honor to be able to be conferred this Dr. Yong Pung Hao chair, because I know he, along with others, was one of the technocrats who worked closely with the political leaders before he himself became Chief Justice. So it's a Before I start the actual lecture, let me just say a word of thanks. I'd like to thank my dean for his support, my colleagues at the school, a great bunch of colleagues, senior leadership at the university, and also a special thanks and shout out to the school's founding dean, Kishore Mehrbani, without whom I wouldn't have actually come back to the school. He played a major role in me coming back to the school, so I'd like to mention that by way of appreciation. So my talk today will be, as the dean mentioned, will be on the financial aspects of globalization, an area that I think has been sort of under-discussed. As many of us do in the school, what I'd like to do is first take you through the definitional and analytical issues, after which I'll use Singapore as a case study to discuss how Singapore's position, was it exceptional? Did it follow the rules? Did it break the rules? So just to understand, so let's understand the analytics first, and then we look at the Singapore case study. So I have a bunch of slides because some of the issues and terms can get quite involved. So let's switch the slides, and as I go, I'll go through them. The structure of the presentation is as follows. First, I'll define financial globalization, and I'll spend quite some time talking about the various nuances relating to financial globalization, because as you'll see, it's not nearly as straightforward as some other aspects of globalization, such as trade globalization. I'll talk about the impacts of financial globalization. Then I suspect time will be my enemy, so I may not go through in as much detail section 3 on capital flows and vulnerabilities, but let's see how we go there. But then I'm keen on coming to the part 4, which is about Singapore's approach to financial globalization. Okay, so let's move to the slides and let's look at them. So when we think about definitions of financial globalization, so before I even talk about financial globalization, let's think about the context, okay? So when we think about economic globalization more broadly, we know there's the trade and financial dimension, which I'll come back to. There's globalization of labor flows and globalization of data and digital flows. What we know about labor flows is that's the one area of economic globalization that's lagged since the Second World War. People talk about the so-called Zlotnik range, where the share of migrant population to overall global population has remained about 2.2 to 2.5%, give or take. It's gone up a bit after the fall of Berlin Wall because there was movement within Europe, but by and large it's been fairly stagnant. In sharp contrast, we know the big area of globalization has been in data and digital flows. We don't have good data. That's one of the paradoxes. We talk about data and digital flows, but we don't have really good data on it. But the best we have here is the McKinsey Global Institute report from a couple of years ago, and they talked about how there was a surge of 45 times between 2004 and 2015, give or take. But we also know, given current ongoings, there are some concerns there with regard to the, protectionism with regard to data and digital protectionism, and so it's going to be an issue about how fast that will continue to appreciate. Let's go to globalization of international trade. Then I'll come to globalization of finance. That is, in some senses, this is a fairly well-known story. We know that there's significant growth of world trade far exceeding the growth in global output, and that continued up till 2008. Then we had the global financial crisis where both took a dip, but trade took a bigger dip. It's recovered since then, but essentially since 2008, the trade to GDP ratios have more or less stagnated. Okay? But we also know until 2008, the reason why there was a significant growth in world trade was because of fragmentation of production. Multinationals, other companies were slicing the value chain and spreading different parts and components across different countries, right? And so, and when we think about governance of globalization of trade, we think about the WTO and also bilateral and regional FTAs such as the CPTPP and the RCEP. As I mentioned, trade globalization sort of has stagnated since 2008, and there are various people talk about triple whammy of the global financial crisis, the US-China trade protectionism, and the COVID-19 pandemic. But over and above that, there are some structural issues. Just like reductions in transportation and communication costs help with the slicing of value chains and made it cost effective for companies to spread parts and components production across different countries. Automation and additive manufacturing are in a lot of ways moving in the other direction. They're concentrating production in one or two countries. So even without the triple whammy, we might have seen a slowdown in the trade growth in the trade to GDP ratio that had been occurring. There's also, as we know, the emergence of the re-emergence of vertical industrial policy across different countries. But as against that, so these are reasons why you would expect trade to GDP ratios to remain stagnant. But as against that, there's some room for optimism, because some folks say, well, it's actually the reason why trade to GDP ratios haven't increased nearly as much is because we're not actually capturing some of this data, whether it's growth in e-commerce, services trade. We don't have a really good handle on it, and these are the areas that in trade are actually growing compared to manufacturing. So in any case, so the economists a few issues ago talked about globalization when they're talking about trade globalization. So they talked about globalization rather than deglobalization per se. But in any case, that's all about trade globalization. Most of us know about that story. Let's look at financial globalization. Now, the problem with financial globalization is there is no single definition as such. When we think about trade globalization, like I said, we talk about trade to GDP ratios. But when you think about financial globalization, there's not even a single proxy, because there's not even a single definition. There are at least three dimensions of financial globalization. There's the movement of cross-border movement of capital flows. There's the internationalization of the financial sector, and there's the internationalization of the currency. I'll leave out the third for later when I talk about the Singapore case study. Let me focus on the first two. So when we think about cross-border movement of capital flows. This is data, so we're talking about gross capital inflows and outflows. This is captured, all countries follow the IMF template, so this is captured in the so-called financial account and the balance of payments. And there are three subcomponents of capital flows. There's foreign portfolio flows, there is foreign direct investment, and there's other investment. Foreign portfolio flows basically refers to any marketable instrument. So it could be a debt instrument, it could be an equity. So it could be foreign equity flows, it could be foreign bond flows, it's cross-border movement of bonds. Other investment is all about bank flows, bank deposits, trade credit. Foreign direct investment is an interesting animal which I want to spend a bit of time on before I move on. So when we think about foreign direct investment, historically, a number of developing countries were very big on foreign direct investment, because unlike the other types of foreign investment which requires a degree of development of the financial system, right? Because if you think about a bank, international bank flows, it has to be intermediated via the banking system. When you think about foreign portfolio flows, whether it's equity or debt, you need a bond market, you need an equity market. Foreign direct investment historically has been sort of a different animal, because you have a foreign company coming in, they're bringing the financing and also actually setting up shop, doing the actual physical investment. So you think about the Japanese car company going into Thailand, for instance. They bring in the money and they set up the company. So you don't necessarily have to have a well-developed financial system. So that's why a number of developing countries were very big on foreign direct investment. There are other reasons as well, which I'll get into. But there's a big caveat here. The definition of foreign direct investment is any foreign ownership stake of over 10%, which means there are really two broad types of foreign direct investment. The first type, which I talked about, which is a Toyota, for instance, or car company, Japanese car company going into Thailand, that's called greenfield investment. But increasingly, a growing share of foreign direct investment in Asia and elsewhere involves what's referred to as mergers and acquisitions. So for instance, if a Japanese company or set of individuals decide to buy over 10% ownership stake in a Thai company, there's actually no new investment per se at that stage. It's really a transfer of ownership. So the type of foreign direct investment matters. Greenfield investment, yes, it could directly lead to increase in investment, growth, etc. Cross-border mergers and acquisition may benefit an economy over time, because they may be foreign owners may bring with them better technology, better ways of doing better processes, etc. But it may or may not, right? And so it may not, cross-border M&A may not even lead to greater investment. Let me explain why. So imagine you have foreign, say I'm a company in this country, a foreigner buys up 10% stake in my company. when I have that liquidity, that having the money that because the foreign company has bought 10% equity stake from me, only if and only if I choose to reinvest that money in my company or in some other company in the domestic economy, does physical investment rise. It may not. I may decide, well, rather than undertake investment, I may decide, well, I'd much rather take the money and consume more. Remember, savings are defined as that part of disposable income that's not consumed. Disposable as in income has remained the same. All that's happened is my stake has moved from a non-liquid form to a liquid form. I have money now. And so if I choose to consume more of that, essentially savings drop, right? And so the point is, mergers and acquisitions, I'm not saying they're a bad thing. They could have positive effects. But it's not so clear-cut compared to greenfield investment, because greenfield investment, like I said, foreign money comes in, physical investment gets done. With M&A, it's not so clear-cut. So let me just jump to the picture. This is about mergers and acquisition as a share of total FDI in a selected set of countries. Few things to note here. I just want to focus on China, Indonesia, and India. It's become, people like to compare these three Asian giants in more ways than one. So if you look at these three countries over the last 20 years, yes, FDI into these three countries has gone up. China certainly much more than the other two, but the other two have also done quite well. But to my mind, it's not the magnitude that's important, it's the type of FDI that's important. In the case of China, generally, if you look at M&A as a share of FDI, it's remained fairly stable at about 10%. Most of FDI that's gone into China in the last 20 years has been, and even before that, has been of the greenfield variety, in manufacturing, in multi-brand retail like the Walmarts of the world, etc. In the case of Indonesia, after the Asian financial crisis, when there was socio-political instability, etc., once things started to stabilize, the first decade in the 2000s was really, they saw a surge in FDI, but a large part of that surge in FDI was mergers and acquisitions. Indonesian rupiah went down, remember, from the peak of about 2,500 to 16,000 when things were really bad. So so valuations had gone down significantly. So once things stabilized and the rupiah was still down, it became cost effective. It became attractive to buy some Indonesian companies and assets. Also, Indonesia, because there are concerns about their problems with the banking sector, etc., they started liberalizing their banking sector, and there was cross-border mergers and acquisitions with regard to the banking sector. And so in Indonesia today, policymakers are very concerned about a fall in the fact that FDI hasn't really picked up. That's true, but I think to a large extent that's because cross-border M&A is no longer as big a deal as it was in the first 10 years. So it's not just the type of FDI, but it's not just the magnitude of FDI, but it's the quality of FDI that's important as well. India's the other interesting case study. There's initially reforms, etc. Some FDI was coming in manufacturing, etc. The last 10 years, before the global financial crisis, a surge in FDI, but a large part of that surge in FDI was again in cross-border mergers and acquisitions. It was the Chinese companies buying tech companies in India, pharmaceutical companies, etc. Again, none of this is bad. I'm not suggesting any of this is bad. I'm just saying that it's a matter of fact. When we look at, it's not just enough to compare China, Indonesia, India in terms of magnitude. Look at the type of FDI, because the macroeconomic effects of FDI, say in China, could be quite different from in the case of India. People tend to forget that. They just look at magnitudes. Let's look at another graph, and this is sort of taking a more picture of emerging and developing countries in aggregate. And what we see here, so just let me go through this graph quickly. So the top part shows you total liabilities, the bottom part shows you total assets. So total liabilities basically refer to inflows, stock of inflows of FDI that's coming, stock of inflows of capital that's coming in. And so what we note here is FDI, what we note is for developing countries, there are two main types of capital flows that are coming in: bank flows and foreign direct investment. And keep in mind, remember, foreign direct investment could be different in different countries, M&A versus greenfield. Total assets show us the capital flows that are, these are stock of capital outflows by developing economies. And what you note here is, apart from bank flows, it's really reserves. What are reserves? Reserves are central bank holding of foreign exchange. So essentially what we have seen here, and data is till 2015, it's not that easy to get the stock data, but if you update it, it's more or less the same thing. Essentially what you have is a global financial intermediation going on. You have foreigners, advanced economies pouring money into developing countries in search of yield or for cost purposes in terms of if you have production platforms, etc., to set up FDI, while the developing countries are reinvesting their reserves overseas. Remember, what are reserves? Reserves occur when central banks intervene in the foreign exchange market and they build up reserves. Why do they intervene? Either to manage their currency or they want to build up reserves for a rainy day in the future. In any case, they build up these reserves. They then reinvest these reserves overseas, primarily in US Treasury bills, because they are looking for, they are trying to minimize risk and they are looking for liquidity, right? And so you have this global financial intermediation that's going on. Let me go on here. I actually forgot to keep pressing this this remote, so let me take over from here. So when we think about, so that's about capital flows. Okay, let's look at the other aspect, which is internationalization of the financial sector. Remember, there are three definitions, right? Global capital flows, internationalization of financial sector, and internationalization of the currency. When we think about internationalization of the financial sector, the easiest way of thinking about this would be to go back to the GATS, General Agreement of Trade and Services, and there are really four broad modes in trade and services. This doesn't have to be of the financial sector, but it's trade and services in general. You have mode 1, which is basically about cross-border movement or cross-border supply. And so here you could think of there could be multiple things, but you could think of two things. One is, for instance, actual cross-border movement of capital. So banks lending or depositing money overseas. But that already would be showing up in the first definition of cross-border capital flows, so we won't worry about that. But there could be other aspects. So for instance, wealth advisory services. If you're advisory service in Singapore and then you provide, you're providing management services or advisory services to a high wealth individual in Indonesia, that would be an example of mode 1, cross-border supply. Then we have mode 2. Mode 2 is consumption abroad. So this would be an example of this would be if from Singapore, if I go to China, for instance, and I use a local ATM, that would be sort of consumption abroad. Or if I go to China and then I decide, as we know, you can't do anything with credit cards or cash in China. So if I open a Alipay tourist pass, that would be an example of mode 2, for instance. Okay. Mode 4 is more about mode 3 is about commercial presence, which I want to talk about. Mode 4 is about movement of people, so I'll leave that aside. That's more about globalization of labor. So when people talk about the internationalization of financial sector, what they're really talking about is commercial presence, mode 3. Most of the literature, academic literature, is focused on foreign bank entry, but it doesn't have to be foreign bank entry. It could be about foreign insurance companies, institutional investors, fintech firms, etc. Okay, but internationalization of financial sector is really about commercial presence of financial institutions. So now, so when we think, before I show you some data, when we think back to development in East Asia, what do and I like Danny and the dean and others have taught courses here in development economics, and we talk about Asia. And when we think about development strategy in East Asia, the NIEs in Japan, newly industrialized economies in Japan, what do we always talk about? We talk about, yes, there wasn't laissez-faire with the exception of Hong Kong and Singapore in some areas. There was significant degree of protectionism, but one thing that they did, all these economies followed, was the focus on the external, focus on export markets. That's how they focused on building a world-class manufacturing hub. And we've seen that with Japan, South Korea, etc., etc. But on the financial side, very different. They heavily repressed their financial systems, which remained very underdeveloped and bank-based. There was significant controls with regard to capital flows, with the exception of FDI in some countries. But even in the case of Japan and Korea, even FDI was curtailed to a large extent, and they did not allow internationalization of the currency. To some extent, when Japan decided they wanted to internationalize the yen, it was a bit too late because Japan had already started their financial crisis, which lasted for the next 20 years. And in the meantime, we had the advent of the euro, we had the Chinese renminbi coming on stream. So that's why Japan its currency never became as internationalized, because when when countries and individuals outside Japan were ready to hold on to Japanese yen in a big way, Japan was not ready for it to happen. When they were ready for it to happen, people overseas were not nearly as interested because they had the big asset price collapse, etc., etc. Right? Let me just point out, I forgot to mention, when we think about this third notion of financial globalization, internationalization of the currency, very simply put, internationalization of the currency basically means that foreigners are willing to hold, trade, and use your currency in a big way outside your country, right? There's a lot of offshore holding and trading of your currency, in any case. So when we think about the Asian financial crisis, yes, it started in Thailand, but and then spread to Malaysia, Indonesia, Korea, etc. A lot of people in political economy, not incorrectly, but they talk about white elephants, poor governance, quality of investment, etc. All true, but first and foremost, the crisis that started in Thailand was because of the financial side. And you think about the mental model of Thailand. This becomes important when we think about the Singapore case study. In the case of Thailand, what happened? They, like Malaysia and Indonesia to some extent, started liberalizing by the late 1970s. All of them had import substitution, industrialization, closed markets. Very quickly, they hit diminishing returns, inefficiencies, etc. They look at the NIEs, and they couldn't even say the NIEs were a different animal because they were in North Asia. In their backyard, Singapore was doing well. Right? So what did they do? They started, by late 70s, early 80s, they started liberalizing on the trade and foreign direct investment side. So that was a good policy, belated but good, but they also had good luck. What was the good luck? The good luck was the Plaza Accord, 1984. Japan, which had been doing very well, like Germany, doing very well in terms of gaining export competitiveness, etc. They had kept their currency fixed for a long period of time. The US, and there was an agreement with the US where Japan finally agreed to stop intervening as much in the foreign exchange markets, and they allowed the yen to appreciate. The yen appreciates. Japanese manufacturers are looking for a cost-effective way, because remember, they had taken decades to build up market share in the US and other countries. They didn't just want to lose market share just because their currency had risen sharply, and they as individual businessmen couldn't do anything about the currency strength as such. So what did? They started looking for cost-effective alternatives. Remember, this was also the time when there was rapid reduction in communication and information costs, so you could segment your production in different countries. So the Japanese were looking to invest overseas. Thailand, etc., had opened up, so there was significant movement of FDI into all these Southeast Asian countries, but Thailand in particular, for various reasons I won't get into here. But in any case, Thailand almost overnight now becomes the Detroit of the East in terms of car manufacturing and other types of manufacturing as well. So the mental model of the Thai policymakers, we opened up some aspects of our economy, we did very well. Therefore, the more globalization, the better. So what did? They liberalized their financial sector. They created what's called a BIBF, which is basically they tried to become an offshore financial center, and they also liberalized their financial account or capital account. That actually is a toxic combination. When you have a combination of liberalization of your trying to internationalize your financial sector, and you allow for significant capital flows, and you don't deal with prudential regulations, that's a toxic combination. So essentially what you had was significant amount of capital flows coming into Thailand between 92 to 95 or so. Remember, people were always thinking, well, Thailand, significant amount of capital flows, they thought it was fine because it was greenfield FDI, and that's true. But that's where looking at the data becomes important. That was true up to about 92 or so. After that, most of the surge in capital flows was of this other investment variety, bank flows, right? And why was there bank flows? Remember, Japan had got into recession. You had zero interest rate policy in Japan. So you could borrow at close to zero interest rates in Japan, turn around and invest in Thailand. Thailand had opened up its capital account. Thailand was considered the darling of the international community, the most likely emerging economy to become a NIE as well. And so a large flood of capital into Thailand, not into manufacturing, into real estate in other areas, and eventually you had a bust, right? And that had other effects. So just to emphasize this point, if you liberalize your capital account, say you have predominantly a financial system that's bank-based, you liberalize your capital account, but you keep a very closed, so tight control on your financial system. it's not so bad because the central bank can use moral suasion to tell the banks, if they say 3 or 4 major banks, they could tell them, don't on-lend this money because it's going to compromise macroeconomic stability. As I'll talk about in the case of Singapore, that's what happened. So opening up a capital account but having a tight control over your financial sector may not be as bad a situation. Similarly, if you open up your financial sector, but you keep your capital account fairly close. Now think about a situation like this. You have new bank entrants. They all want to compete for funds and new markets, etc. But they have to get the funds. In the case of Thailand, these non-bank financial entities could go overseas and get the money fairly cheaply and then on-lend domestically without taking into account proper prudential regulations. That caused the boom which eventually bust. But if I don't open up my capital account, but I liberalize my domestic financial sector, there's less of a problem because the main source of funding would be domestic deposits, and that there's a limit to how much domestic deposits there is, and or monetary policy, which again is under the control of the central bank. So a toxic combination of internationalization of financial sector and opening up of the capital account without dealing with the prudential regulations dimension of it is a recipe for disaster, as happened in Thailand and a number of other developing countries. So let me, having talked about the NIEs, let me just show you a couple of graphs. So the first one is about international trade integration. So this is, as we know, international trade integration in the NIEs, this is ASEAN plus 3, but if you think about East Asia as a whole, we know on the trade side, much more open than the rest of the world. But then when we look at the financial side, very different story. Right? As we talked about before, on the financial side, the NIEs, with the exception of Hong Kong or East Asia generally, has been much more circumspect about allowing for financial globalization. So on the capital account side or financial account side, you see that they are much lower than the rest of the world. So that's about the capital flow side. Now let's look at the other dimension of financial globalization, which I mentioned, which is internationalization of the banking sector. East Asia, very close for a long period of time. There was some opening up after the Asian financial crisis because Indonesia, etc., needed to recapitalize their banking system. China and Vietnam, after the WTO agreement, there was some hope that there would be, when I say hope from the perspective of advanced economies, that they would start opening up their financial sector. Countries like India, Myanmar, etc., also did a bit of liberalization on the banking side. And of course, the big change was free trade agreements. That's when countries like Singapore started opening up their banking sector. So there has been an impetus in recent times to open up the banking sector. But despite that impetus, if you look at the graph below on foreign bank presence, you still see East Asia and South Asia, if you take broader notion of Asia, much below Latin America, Central and Eastern Europe. Sub-Saharan Africa is a different animal here because a lot of the foreign bank presence is a combination of foreign banks that existed during the colonial period that remained, as well as sort of global African banks. But the real story is Asia compared to Latin America and Central and Eastern Europe. Okay, so on the financial side, the point about all of this is to point out on the trade side, highly globalized Asia, but on the financial side, much more circumspect. So let's move on. So now when we look at, when we think about the sort of, if you will, let's move on from definitions to look at the impacts, okay, of financial globalization. I'm skipping through a couple of things because I'm eager to get to the Singapore case study. So when we think about the impacts of financial globalization, so remember there are different aspects of financial globalization. So let me focus first on the internationalization of financial sector per se. I'm not going to go through this chart here, but my point about all of this is there's been a lot of literature looking at the costs and the benefits of foreign bank presence. And when we think, so broadly speaking, there are three dimensions. A set of literature has looked at the pro-competitive gains from internationalization of the financial sector. It's all about the bank efficiency. Foreign banks come in, they bring with them new technologies, they promote greater competition to domestic banks, etc. So there are all these pro-competitive gains. But then you also have, there's another set of literature that talks about financial development. And here the argument is, let's look at the financial inclusion side. The argument here is with greater competition and more suppliers of financial intermediation, there may be more alternatives to serve areas that were underbanked or unbanked. Okay? So that may help financial inclusion. and so if you think about it, that's, if you will, the fintech kind of argument. You can draw a parallel there, right? And so you could have a situation where new banks, new foreign entrants come in, they drive out the incumbents. The incumbents then, because they have better soft information about the unbanked and underbanked in the country, but before they had no incentive to really service them, now move and service those unbanked and underbanked, thus enhancing financial inclusion. Or you could have a situation where foreign banks come in and they bring with them better processes to be able to figure out credit ratings, et cetera, again, the fintech argument, and they're able to now promote financial inclusion. But the point is, there's a whole literature that talks about how foreign bank presence could help with financial development. One aspect of financial development is financial inclusion, whether it's on the household side or on the firm side, as trade credit to small and medium-sized enterprises. And then there's also this other dimension of financial development, which is financial sophistication. Foreign banks come in, they bring with them know-how in terms of derivatives and other types of things, and they help deepen the domestic financial markets. There's a third strand of literature in this area that talks about macro financial stability. And here the argument basically is foreign banks come in. When a foreign bank comes in, if you have a domestic bank, its primary asset base is domestic. So if there's a recession domestically, that could have repercussions on the banks and therefore the whole financial system, and you have this negative loop between weak economy, weak financial system, which then affects the economy again, and goes on and on, right? So one of the arguments is when you have foreign banks, they have diversified asset base, and that helps make the financial system a bit more durable. They also bring with them better risk management, supervision, etc., less connected lending, etc. In any case, this was the argument that had been made that's been made in literature. There are lots of benefits from foreign bank presence. But what we saw, both anecdotally with the global financial crisis, but also empirically, in practice, the benefits of foreign bank presence are not nearly as straightforward. And there are a number of issues that have come up. One that I talked about, absent strong prudential regulations, financial liberalization could lead to excessive credit growth and eventual crisis. Foreign banks could come in, rather than promote financial inclusion, they end up cherry-picking clients, so the urban credit card market, as it were, and that then and domestic banks trying to maintain market share, they lower their standards and they build up more risk on their balance sheets. That could end, rather than promoting financial inclusion, it could end up creating more risk in the financial system. Also, more and more of this literature talks about thresholds. It's not the case that foreign banks come in, things in terms of monetary policy, transmission, interest rate transmission, etc., improves. What we find is there exists a degree of this certain threshold, meaning if foreign banks are below that entrance of foreign banks is below a certain threshold, they may not be these positive effects. You have to have a critical mass, as it were. Okay? And then, as we saw with the Eurozone crisis, remember, prior to all this literature, prior to Eurozone crisis, a lot of discussion was how foreign banks could help stabilize the financial system in terms of asset diversification, etc. But what we saw with the Eurozone crisis, they could also be the source of international bank contagion. Spanish banks, Spanish economy is affected, Spanish financial system is affected. They have a big presence in the rest of Europe, and therefore the rest of Europe's financial system and therefore economy gets affected. So you could have this international banking contagion going on. And also, if you allow for too many foreign banks, you could end up with a situation where your domestic banks are driven out, and you move from a concentration. So you have a situation prior to internationalization, you had a concentration of state-owned banks, but after internationalization of financial sector, you have a situation where your financial system remains concentrated, but it's dominated now by foreign players predominantly. This happened in Central and Eastern Europe. This is an issue that Singapore has always been concerned about, because they wanted to make sure that the domestic financial system had some strong competitive domestic banks, which are important for various reasons I'll talk about. Okay? So what does the literature tell us about all of this? So yes, there are benefits from foreign internationalization of financial sector, but there are also significant potential costs. And so what countries in Asia seem to have learned is it's important to take a calibrated approach. So remember I said there was an impetuous after the Asian financial crisis, and with the entry of China and Vietnam into WTO, people thought there would be a massive increase in the internationalization of financial sector in Asia. Hasn't happened. What they have what much of Asia has taken away from this is there's a need to take a carefully calibrated approach to foreign bank presence. So what does that mean? Make sure you have a strong domestic, stable domestic banking base. Build up your prudential regulations before you do anything. And if you diversify, make sure you diversify the countries where your foreign banks originate from. You don't want to have most of the foreign banks coming from one country because of that country, there's a problem in that country, then there could be a negative contagion to your country. So diversify, allow for foreign banks. If you're going to allow for them, make sure it's diversified across different countries, not just a single country. Right? And so the other thing that a lot of Asian economies have taken away is there's a need to ensure that allow for foreign banks, but allow for subsidiarization rather than bank branch. What does that mean? A foreign subsidiary basically implies that you have to follow the prudential regulations and other banking regulations set out by your domestic regulators. A branch, on the other hand, you're exempt from these regulations, right? So essentially, if you think about this, subsidiary versus branch, so you could have a situation where you say, I don't want, on the one hand, you could say, I don't want too many foreign banks because of all the potential problems. Or you could say, fine, I'll allow for foreign banks because of the benefits they bring, but they have to locally incorporate. They have to become a subsidiary, not a branch. You say, what's the big deal? It is a big deal because for a number of countries, that's one of the reasons, for instance, you don't have as many, even though a country like India, for instance, on paper, very liberal as far as its banking sector is concerned. But in practice, not that many foreign banks. There's been a declining market share of state-owned banks, and that's been taken up by domestic private banks, but not foreign banks. Malaysia would be the other example. You have significant amount of private banks in the economy, Maybank, etc., but not as many foreign banks per se. And the point is this, when I say local incorporation, if I have a lot of other regulations, so for instance, for financial inclusion purposes, I may say that banks have to ensure that a minimum percentage of their loans have to be given out to the rural sector or underserved, etc. Or I could say, you need to make sure you have a minimum number of branches. Branches I'm using as sort of not as a branch versus subsidiary, branches in terms of outlets. Minimum number of outlets in the rural sector. These add up to costs to a foreign bank. And a lot of foreign banks may decide it's not worth yes, I want to come into your country, but the costs are too high, so I might choose not to come in. So essentially, by getting more banks to become subsidiaries rather than branches, essentially what you're doing is creating a degree of fragmentation, and there's de facto, you're on a de facto basis, you're actually reducing the degree of financial globalization. Let me pause here. Analytical frameworks are important. So let me pause here and talk about what's referred to as a financial trilemma. There are a lot of trilemmas in international economics, political economy. There's a Danning-Roderick political trilemma, which talks about sovereignty versus democracy. There's the age-old monetary trilemma, which talks about exchange rate versus monetary policy autonomy. But financial trilemma is somewhat less known. So let me quickly talk about this. Financial trilemma essentially says, think of three objectives that a country has with regard to the financial sector. Financial stability, maintaining your sovereignty with regard to financial policies, and financial integration. Financial integration here narrowly referring to allowing internationalization of the financial sector. So the financial trilemma says at any point in time you can have two of these three. So what do I mean by this? Let's say you have a situation like this. A country says, okay, for financial stability reasons, I want to ensure that banks don't overexpose themselves to the property market, for instance. Okay? So you set a regulation with regard to that. Okay? So you have your own sovereign regulatory policy on the one hand. So you do that, but then if you have a policy there, but then you say you have both subsidiaries and branches in the economy. If all the subsidiaries, both your domestic economy, domestic banks as well as foreign banks that are subsidiaries, have to follow this rule that you have. But branches don't need to. So essentially what happens, if you allow for a high degree of internationalization of financial sector, in this case allowing for branches not requiring them to locally incorporate, then that could potentially compromise financial stability because the subsidiaries and domestic banks can't lend out to the property market, but the branches can. So essentially you choose to maintain sovereignty over your national financial policy in this case, and you've allowed for financial integration, a lot of branches, essentially you will have to compromise financial stability. So if you decide that you want financial stability and sovereignty over your national policy, you have to give up a degree of financial integration. That's what a lot of, much of Southeast Asia has done. Again, leave out Singapore as a special case, as I'll talk about. Some people lament that, yes, we have the ASEAN Free Trade Agreement, but not as much has moved as in terms of the financial, on the financial side. On paper, we have the ASEAN Bank Integration Framework, the ABIF. But the ABIF has been very slow moving because essentially it's countries have to agree on a reciprocal basis to allow for individual qualified financial institutions to enter the country. So Indonesia, for instance, agrees to allow for 3 banks from Malaysia and vice versa. It's not ASEAN-wide. ASEAN ABIF just provides a framework as such, number one. Number two, even if 2 countries have this bilateral agreement, each of these countries still maintain their own national regulatory policies. So effectively, on a de facto basis, you're limiting the extent of financial integration on the banking side. On the other hand, you think about Europe. Europe has been talking about the banking union. Nothing concrete has happened. I'm not talking about the monetary union here, the banking union, right? The monetary union is all about the euro. On the banking union side, especially after the Eurozone crisis, they've been talking about, much of Europe has been, Western Europe has been talking about how it's important to have a common deposit insurance framework, have a common EU-wide resolution or restructuring framework for banks that have problem. Let's have common regulatory policies. So they are essentially, you can think about Europe as saying, yes, we want financial stability. Yes, we want financial integration, at least intra-EU financial integration. And we are willing to forsake a degree of sovereignty on the national financial, on our, with regard to financial policies, right? ASEAN, on the other hand, has said financial stability, more or less complete sovereignty on the national financial policy side, and therefore they have compromised a degree of financial integration. So that's sort of, I think the Europe-ASEAN comparison here is interesting. So that's again on the internationalization of the banking sector side. Let's look at the other dimension of financial globalization, which is about the capital account, right? Again, in theory versus policy, or theory versus what happens in reality. If I were to teach this to an undergrad or master's student, I'd say, well, from a textbook perspective, an open capital account can be, meaning allowing for free flow of capital, can be potentially very beneficial, because if you have a closed capital account, remember the amount of domestic investment you can undertake is limited by the amount of savings. But when you open up, you could draw on foreign savings, right? Foreign savings could supplement your domestic savings, and that. So if you think about foreign savings as being greater supply of funds, investment being demand for funds. So for a given demand for funds, if you open up your capital account, there's greater inflow of money, so the supply of funds rises. What happens? The cost of funds, whenever supply increases relative to demand, the price or cost, in this case the cost of funds, comes down, right? And that could promote investment, etc. Also, there could be better risk-return trade-off, because now I don't just have to think about risk-return in my domestic economy, I could think about an entire portfolio of investments globally, right? You could also open capital account in theory could also help in terms of welfare, because, so think about a situation like this. You as an individual have 2 sources of income, as it were, your actual income from working domestically and your income generated from investments. So if you have an open capital account, imagine your economy goes into recession, you get unemployed, etc. You lose one source of income. But if you have a well-diversified, internationally diversified portfolio, if the rest of the world is doing well, your returns on that portfolio will be okay, and so that could help buffer your overall income and therefore your consumption. And there could be other benefits in terms of when you open up your capital account, you're forcing yourself to undertake good policies, because very quickly the market will punish you if you undertake bad policies, etc. So in theory, a lot of potential benefits from an open capital account. But in practice, when I say in practice, also more involved literature suggests actually that the growth benefits of an open capital account are not that clear-cut. So there have been a multitude of studies, country studies, panel studies, etc. And basically, there have been, for a number of years, academics have been hard-pressed to find a clear relationship between growth and an open capital account. And increasingly, people are realizing that the reason is because there exists a whole lot of thresholds. institutional thresholds, regulatory thresholds with regard to accounting standards, etc. So countries that are below these thresholds, when they open up to international capital flows, they could actually end up in a global financial globalization trap, constant booms and busts in their economy. You need to, so if you have low levels of financial market development, poor institutions, weak regulations, etc., then you could also end up attracting a wrong type of capital. This would be the Thai case from 92 onwards, where they started attracting a lot of mobile capital, right, which could then have problems over time. Right? So there's no clear-cut relationship between an open capital account and growth. The IMF, remember, the IMF until the Asian financial crisis was one of the biggest proponents of an open capital account. To their credit, over the last 20 years, they've become much more nuanced in their approach to an open capital account, and they also recognize, I just read this quote from Jonathan Austria at the IMF. The IMF recognizes that full capital account liberalization is not always an appropriate end goal, and further liberalization is more beneficial and less risky if countries have reached certain thresholds of financial development and financial and institutional development, right? So there are lots of ifs and buts, many more ifs and buts compared to trade. Again, I'm not suggesting just liberalization of trade, everyone is going to benefit. We know from trade theory that not everyone benefits, but in general, the pie increases, then it's up to appropriate government policies to share those pies between the winners and losers. But in the case of financial globalization, there are far more ifs and buts. It's not so clear-cut that financial globalization is always automatically beneficial. This is just showing you, you had a big sort of a set of emerging economies in Asia and elsewhere between 97 and 2001. There was a spate of currency crisis during that period, then a degree of stability, then again around the global financial crisis, again another big spate of crises that had hit a number of countries. Okay? So I guess just to go back here quickly. So the point, so there are 2 points I'd like to make about an open capital account. One, the benefits are not always clear-cut. Again, if you have all these thresholds, a country like Singapore can benefit enormously. A lot of those textbook benefits I mentioned would work for a country like Singapore, but it may not if you don't have those if you don't pass that threshold. Number one. Number two, even if you do, so the growth benefits are uncertain, but even if you meet those thresholds, even a country like Singapore, for instance, an open capital account makes you susceptible to booms and busts in capital flows. So the basic point is, so the question from an academic perspective that one could ask is, are the benefits of a completely open capital account necessarily worth it, right? In the case of financial sector, we know what East Asian economies have done. They've been much more nuanced. But in the case of the capital account, East Asia has been different. They have said they're going to keep an open capital account. And countries that don't have a completely open capital account, like China and India, are gradually moving towards one. So notice, so the appropriate public policy question with regard to internationalization or globalization of finance in terms of capital flows, the appropriate question is not, is there an optimal level of openness of the capital account? That's an interesting academic question. Insofar as the countries have decided that they have or are moving to a very open capital account, the real question is, how do they safeguard themselves against sudden reversals in capital flows, right? And so that would be the next part of the discussion. I'm going to run through this very quickly, if you don't mind, because again, I want to get to the Singapore story and then want to leave enough time for questions. But let me just give you a sense of how countries in Asia and elsewhere that have chosen to have an open capital account, how are they trying to buffer themselves against possible shocks? One obvious way they've been doing this is by building up significant reserve holdings. Right? This is showing you global foreign exchange reserves, but essentially 2/3 of global foreign exchange reserves are held by East Asian economies. China primarily with about $3 trillion, Japan, Korea, etc., etc. Right? So now think about, remember one of the charts I showed you, global financial intermediation. This is what's going on. You have an open remember I said one of the main capital outflows from the developing world has been in the form of reserves. This is what's been going on. They have an open capital account. They're building up their reserves as a precaution. They could also build up reserves as a side effect of trying to keep their currencies undervalued, as some countries do, but let's focus on the precautionary motive. They build up their reserves as a precaution because they want to maintain an open capital account, but they want to buffer themselves against a shock. What do they do with their reserves? Rather than just keeping it as US dollars, they want to get some some return on this. So they look for the most liquid form of US dollar assets, which are treasury bills. Right? And so that's the global financial intermediation that's going on. This is just showing you there's a big academic and policy discussion about how much is enough. You say reserves are important, certainly, but do we have a good sense of reserve adequacy? That's one of the areas of research I and co-authors have worked on, but I won't get into that. But just to point out that IMF has a nice rule of thumb with regard to reserve adequacy. And just to point out here that of these countries, surprisingly, in magnitude terms, China has massive amount of reserves, but in terms of reserve adequacy, it seems to be slightly lower. Reserve adequacy, again, takes into account things like trade openness. It takes into account openness with regard to your the banking sector, etc. Right? What happened in China was a few years ago they had built up the reserves to up to $4 trillion, and then almost overnight they lost $1 trillion, and so that's why they've come down. So the China story is interesting because it tells you that yes, you want to build up reserves for in the event of a shock, but how much is enough? And reserves are costly. You're basically parking your money as a developing country, you're parking your money in low-yielding assets. So the costs are quite high. So that's why countries in Asia and elsewhere, because how much is enough and it's costly, they've been talking about regional cooperation. So that's why we have the Chiang Mai multilateralization initiative that talks about reserve pooling, etc. But all of these things require countries to forsake a degree of policy sovereignty. And so they've taken baby steps towards some of these regional initiatives, but haven't moved nearly as aggressively as one might have liked. So reserve holding is important. The other thing to pay attention is not just the magnitude of capital flows, but the composition of capital flows, like we talked about. Capital flows that are of the FDI variety, especially for greenfield FDI, much more stable and durable than short-term bank flows or portfolio flows. So if you look, for instance, at this, during the Asian financial crisis, 97, 98, you notice the major outflow that took place was in the other investments, which is really about short-term bank lending, bank deposits, bank lending that reverse direction. If you look at during the global financial crisis 2008, 2009, you had a 1-2 punch. Initially, you had portfolio equity flows leaving, and then you had bank flows going out, right? And then when we had the taper tantrum in 2015, 2013, and 2015, other bank flows happened. So essentially, pay attention to the composition of capital flows. People talk about mobile capital, which is other investment and portfolio flows, versus FDI. I would say, but yes, it's important to look at the composition of capital flows. What is less clear is how do you do it? Meaning, does this imply that you have to bias your capital flows in some way? Does that imply partial capital controls or other types of taxes on short-term capital flows, et cetera, but that's a bit more controversial. But pay attention to the composition of capital flows. Degree of leverage matters. Remember, we talked about the Thai case, and essentially, studies after studies have shown that one of the leading indicators of currency and overall financial crisis is when you have a combination of significant credit growth, whether it's business firm level credit or household credit, as well as sharp asset price appreciation. The combination of those two things has been one of the most important indicators of vulnerability to a crisis. Happened in Thailand, has happened in a number of other countries. Importance of flexible exchange rate regimes. This can be a whole talk on its own about the importance of about talking about types of exchange rate regimes, etc. But conventional wisdom suggests that if you have a flexible exchange rate regime, so think about a situation like this. You have an external shock. So capital leaves your country. If capital is leaving your country, so the idea being that if you allow your exchange rate to help, a flexible exchange rate could help buffer that shock to some extent. That reduces the impact of that shock on the domestic economy. And you could also think of it this way. This would be the Indonesian case, right? You allow for your currency to depreciate. Over time, what happens? That capital outflow starts slowing down because now assets become relatively attractive in Indonesia become relatively attractive when measured in a foreign currency. The controversy here is, well, you have the other dimension, which is a lot of emerging economies, directly or indirectly, have a significant amount of liabilities in foreign currency terms, primarily in US dollars. So a depreciation of the currency could also have all these other negative balance sheet effects. So this is more controversial, but just wanted to point out this is one issue to keep in mind as well. The other thing that's important, and this is where a lot of the East Asian economies, ASEAN and countries like Korea, etc., have taken to heart, is to have a degree of financial market diversification. Former Fed Chairman Alan Greenspan talked about how one of the problems in East Asia, yes, they had a financial crisis. The financial crisis turned into a full-blown real sector overall economic crisis and a socio-political crisis in the case of Thailand, because they did not have a spare tire. When the banking sector went under, the financial system basically collapsed. So one of the issues, one of the policy implications that Asia took to heart was to diversify the financial sector. Yes, make your banking system more durable, but also build up other areas of the financial sector, the capital markets, the portfolio, bond market, equity market, etc. This has been a policy priority for the ASEAN +3 when we talk about regional cooperation. But having said that, so yes, they have diversified significantly, but that's also led to a couple of problems. What are the problems? One is about they've opened up, while they have closed up kept their banking sector fairly tight. The problem is their bond market has become very open. So countries like Indonesia in particular, but also Malaysia, significant foreign ownership in their bond market, which means that if there's a problem internally or externally, significant amount of the foreigners are the first ones to flee usually. I'm not suggesting domestic Indonesian residents, etc. There's not capital flight, but it tends to happen that the foreign investors tend to leave quite quickly. Okay, so that's one of the new areas of concern. The other area of concern is that while the bond markets have developed and the government bond markets have become more local currency rather than foreign currency, and that's a good thing because they don't have these negative balance sheet effect, companies have borrowed significantly overseas. So countries in ASEAN +3 have accumulated a significant degree of US dollar denominated debt, right? And that's been a source of concern. It's also one of the reasons why East Asia, even though on paper they may say they have a flexible exchange rate, they may have flexible exchange rate regimes, and yes, much more flexible than it used to be. They are still much more careful than advanced economies allow in terms of allowing for too much exchange rate flexibility. So very quickly, let me talk about some aspects about the Singapore story. Okay, what do we know? Financial services sector in Singapore, very important in terms of 13% of GDP in 2019. In terms of service exports, 15%, 6% in terms of employment. And unlike a lot of other parts of the economy, the financial sector has been the one that's been very durable during this whole COVID-19 situation. We also know the Singapore financial system is highly internationalized. People tend to obsess too much about rankings. I'm not worried about the rankings here, just pointing out that Singapore, what we know is it's one of the most important global financial centers. So highly liberalized in terms of the banking sector and the financial sector in general. In terms of capital flows, if you look at the stock of assets to liabilities, massive, right? It's sort of 200% of GDP in globally, 2,000% in the case of Singapore. Yes, it's stagnated. There's a sharp jump up after during the Asian financial crisis, which itself is an interesting story. But the more general point is very open in terms of the financial sector, very open in terms of the capital account. Just to point out, when you compare Singapore versus the rest of ASEAN +3, it's a complete outlier there, right? So completely open. So that's what they are now. What did they do? How did they get here without any major crisis? Again, I'm not suggesting that there are no problems. Of course, at a micro level, there have been some problems with regard to individual financial institutions, or we knew from a few years ago, we heard about Nick Leeson's and Barings, but there are micro problems happen in every country. What I'm talking about is about a full-fledged currency crisis that's happened in other countries. Why has Singapore generally been able to why has it had such an international financial sector, very open capital account, but not had this kind of crisis? So let's look at these various parts. Remember, we need to look at these three parts: open capital account, openness, the financial sector internationalization, and the currency internationalization. Very quickly on the capital account side. Capital account side, not as interesting a story because from the late 70s onwards, they've been generally open. But the interesting story is not what they did on the capital account, but how come they weren't faced with booms and busts of capital flows. So essentially what we had in the case of Singapore in the early stages of development, like in the case of some other NIEs, significant amount of foreign direct investment as well as long-term bank lending. But the so-called mobile capital, very limited. Why? On the capital market side, well, capital markets were not developed, so there's not much with regard to equity flows and bond flows. The bond equity flows, not very much. The bond flows, again, bond market hadn't developed for various reasons. Two main reasons. One is for bond market to develop, you need a healthy government bond market. But Singapore is running fiscal surpluses, etc., very fiscally disciplined, no need to issue bonds, and so the bond market really didn't develop. The other aspect is they had this policy of non-internationalization of the Singapore dollar, which basically, remember, the whole idea is internationalization means foreigners are able and willing to hold on to your currency overseas. If I have a policy of non-internationalization of the Sing dollar, if I'm a foreigner, if I hold a Singapore dollar bond, that's going to reduce the liquidity because if I sell the bond to someone, then I have and I get Sing dollars, I can't be holding it. I either have to convert to foreign exchange. And so because of the non-internationalization of the Sing dollar, there wasn't as much appetite for Singapore dollar bonds, and so it didn't really develop. So on the portfolio capital market side, there was not much by way of capital flows. But on the banking side, that's more interesting. Singapore had a fairly open, remember before they became a regional financial center, they were an offshore financial center. Dr. Yong Pung, when he was in the MAS, was instrumental in policies with regard to this. But despite having an open offshore financial center, which means a lot of capital could be coming into the country, not much of that short-term capital flows actually came into the country. So this is where the Singapore versus Thailand story is interesting. In the case of Thailand, what we had was a situation of out-in, meaning financial institutions were getting money from overseas, bank deposits, and on lending it domestically. Singapore's offshore financial center policy, basically, it was a policy of out-out. Money comes in, doesn't touch the domestic economy, so Singapore is an offshore financial center, but doesn't really, not much of that foreign money foreign bank flows come into Singapore. Okay, so that's why they had capital flows in terms of FDI and long-term bank loans, not so much mobile capital flows. Internationalization of the currency, I talked about this before, but just a quote I think would be useful. Again, this period of time, early 80s, very critical, because this was the time when Dr. Goh Keng Swee became chairman of the Monetary Authority of Singapore. Dr. Yong Pung How came in as managing director, then he moved to GIC, etc. So Singapore did a few things here. They set up their exchange rate centered monetary policy, so-called band, basket, and crawl regime, where basically they said, while many other countries control their interest rates, we are going to control the exchange rate. Because they were controlling the exchange rate, they wanted to make sure that there was not too much volatility on the exchange rate. Not having too much volatility on the exchange rate, which means that they didn't want to allow foreigners to hold too much of their currency offshore, right? And so that's one of the reasons for the non-internationalization of the Singapore dollar. Over time, as they got more confident with their own regulations and they wanted to start developing their capital markets, they progressively liberalized or relaxed the non-internationalization of the currency, and effectively now it's on paper highly internationalized currency. The last point, internationalization of financial sector, which remember I said Singapore had a policy so now think about Singapore's mental model here. On the one hand, they look at Japan and the other NIEs minus Hong Kong and say, yes, we want to do what they are doing, build up our export prowess, etc. And they did that by allowing for foreign direct investment. The role of Economic and Development Board here obviously is critical. But at the same time, they said, well, Hong Kong is a major financial center, plus there's a lot of US dollars floating around with the Vietnam War, etc. Can we not get a piece of that action, right? So essentially he said, but maintain tightly controlled domestic financial system, but let's let's open up and have sort of become an offshore financial center, right? So, and that's where they created the Asian Currency Unit, which was created in 1968. And so now you have partial liberalization of the financial sector. Foreign banks were allowed to domicile in Singapore, but they were only allowed to partake in the Asian Currency Unit. They could not deal with the domestic bank, domestic transactions in terms of domestic lending, deposits, etc. That was reserved only for domestic banks, right? And Singapore, for a long while, had basically an oligopolistic market structure. We had the postal savings network, which again was a Japanese invention. Korea, etc., also had, and other countries had postal savings network, but they basically had 4 domestic banks, right? So it was really safety and stability over any kind of innovation or efficiency. And this was a trade-off they and other NIEs accepted because they wanted to make sure financial system was too important to be left in the hands completely of the wild west in terms of free market, because we wanted a stable and durable financial system so we could deal with the manufacturing, deal with employment generation, etc. And MAS, now we think about MAS as being at the forefront of innovation, etc. But MAS earlier on, they had this. They used to have this. This used to show up in the annual. I don't know if every annual report, but certainly a couple of annual reports. The authority, meaning the MAS, has since 1981 emphasized the importance of self-regulations by financial institutions. Banks are expected to run their operations prudently to comply both with the letter and spirit of the rules, regulations, and guidelines laid down by the authority. So why is this important? Important in a number of ways, but think about a situation like this. How can you have, so if I have a domestic bank, for instance, okay, I have both a domestic banking unit and I can also partake in the Asian Currency Unit. I can get cheap foreign money from abroad, then I can, there's nothing to prevent me as a domestic bank to then intermediate some of the cheap funding and use it and lend domestically. Right? Very quickly, if you take your eye off the ball, very quickly this could turn into a massive credit boom and asset price bubble, right? And so it was important, and you could set specific regulations here and there, but if there's an incentive, institutions are always going to find their way out. So it's not just important to follow the rule of the law, but the spirit of the law. And that's also important to why they had. It'd be very hard if they had a very internationalized banking system, because it'd be very hard to be able to use moral suasion on the banking, foreign banks, etc., in the manner they did with domestic banks. So 2 things and then I'll end. So now over time, so remember, they always had an open capital account, but because of the non-internationalization of the currency as well as the way they dealt with banking regulations, it didn't lead to significant booms and busts, predominantly FDI and long-term bank lending. They liberalized they allowed for gradual internationalization of the currency over time. And again, when I say over time, they did it very gradually. Internationalization of financial sector. So for a long while, remember, sleepy banking. Asian financial crisis occurs. Singapore has come out relatively well from this. Yes, the economy stagnates, unemployment, but that's to be expected because your hinterland has gone into deep recession. But there was no collapse of the financial system. So the regulators here and policymakers took away from that their regulations they have are solid. They have a good system in place. Now maybe they should take the next step and start building up the financial system, allow for greater efficiencies of the financial system, etc. And so but they are still concerned about allowing for too much internationalization of the banking sector. So what they did initially was to allow for deregulation of the banking system, allow for more private banks to come in. So for a while we had Keppel Bank, Keppel, Tatley Bank, etc. But very quickly things change. Remember what people say, if your Keynes had said, right? If the facts change, I'll change my mind. What about you? So they did the same thing. In some senses, they realized, well, maybe this might not be the way to go. Now, again, it could be it was a grand plan. If you talk to policymakers or older more experienced policymakers, maybe they'll tell you more about this. But my reading of what happened was the following: they did the initial privatization, but then they realized things were changing. They had to start opening up to foreign bank entry for various reasons. One, because just the ongoing rapid financial innovations. If it's not banks, it would be non-banks, fintech companies that will start coming in. You sign all these bilateral FTAs. Remember, WTO essentially had stagnated in terms of moving forward. They weren't moving forward with anything. ASEAN, which had moved forward until 97 on the trade side, they had other things to deal with. Malaysia, Indonesia had their own crisis to deal with, so there was nothing moving on that side. So Singapore started all these bilateral free trade agreements. If I'm Singapore, I have an open trade, very open on the trade side. What do I negotiate? Obviously, countries like the US are going to, apart from government procurement and other things, are going to also ask me about my financial sector. So it's inevitable that I'll have to start liberalizing, opening up my banking sector. And plus, Indonesia, Malaysia, etc., had started, or Indonesia and Thailand and Philippines in particular, because they had to recapitalize their banking systems, were opening up their banking system to some extent, and so there may be opportunities overseas. So now the issue is the following. Yes, Singapore has to open up, and there may be opportunities, but they don't want to just open up willy-nilly and allow the domestic banking system to be dominated by foreign banks, as has happened in Central and Eastern Europe. That itself leads to other problems. So what do? You first scale up your domestic banks. So they reverse their policy of liberalizing on the domestic side. They effectively forced, or they incentivized, or they strongly suggested that banks start consolidating, and they ended up with three banks which still dominate the domestic scene, right? You have DBS, UOB, and OCBC, right? And then now that you have a strong domestic banking system, now as you start opening up to the rest of the world, banks, the city banks of the world, etc., you know that your domestic banks are not going to be completely pushed out of the domestic market, right? And that was so. And this actually is important in terms of, for other countries, the best time when you liberalize, do it from a position of strength, if you can. Of course, sometimes it's crisis related. You have to. You don't have much choice. So I've already talked about this. I'm going to skip this part if you don't mind. So just very quickly, let me go forward. So of course, there are a lot of other details, but analytically, I just want you to understand where Singapore is coming from, because people come to Singapore, to our school for executive education, other things. They want to hear about how let's talk about Singapore's financial system. How do we become an international financial system like Singapore? It was a painstaking step-by-step process, and they understood there are various dimensions of financial globalization. They didn't just think about open versus closed. It was very nuanced. So there are some. Now that they have become completely open in terms of the financial side, so you can certainly say today Singapore has truly embraced all aspects of financial globalization. There are a couple of challenges. They have to be always very careful about the prudential regulations, both on the micro side as well as macro side. So now you have this constant, not really trade-off, but something to keep in mind, right? You want to maintain very tight regulations, but at the same time have a very business-friendly environment for financial institutions. So just to give you a sense, when we think about these different types of prudential regulations, so monetary policy is all about price stability, etc. Microprudential regulation is all about stability of individual financial institutions, protecting the consumers, etc. But what's important, and we have seen this after the global financial crisis, the macroprudential regulations. Individual countries, individual financial institutions could be following domestic micro regulations, but they may be, the risk could still exist in the financial system. It's just been transferred somewhere else. That's what macroprudential regulations deal with, right? So Singapore, Ravi Menon, the managing director of MAS, he takes pains to mention that macroprudential regulations, which Singapore does a lot about. Again, there's a lot of nuances with regard to what these macroprudential regulations are. I'll leave that for another lecture. But he's taken pains to emphasize that capital controls are about outside the border, as it were. Macroprudentials are not capital controls. They're all about within the border. They're inside the house, as it were, targeted at sectors where financial vulnerabilities are building up. I'll skip this slide, but essentially, both for Hong Kong and Singapore, much of their macroprudential regulations are focused on the property market, because the property market is such a big aspect of the overall economy. So what are some of the current challenges with regard to when you think about Singapore's approach to financial globalization? Become very innovative. So how do you nurture a fintech ecosystem that promotes innovation while still managing financial stability and related risks? Just yesterday, I think there was in Straits Times, in the local newspaper, there was some discussion about how MAS is tightening up on cybersecurity. There's this ongoing concern. Singapore just allowed for digital banks. That's a whole new area of concern. How do you make sure they may be institutions that are not financial institutions necessarily, but they are coming into the financial sector. How do you manage and supervise them? Beyond supervision, the whole issue of green financing, the role of green finance. This is one of the things that a couple of PhD students in our school are starting to look at. We know as Singapore is promoting green finance, through fund mobilization, through providing incentives, etc. There's this regulatory aspect about how do you deal with the financial impact of climate risks. There could be physical risks, meaning you're exposed to an institution or an area that actually goes through actual earthquake, etc. There could be physical risks, but there are also so-called transitional risks. As consumers start moving away from fossil fuel-related industries to other more green industries, that's going to negatively affect the industries that are related to fossil fuels. And if the financial system has significant exposure to those industries that are not that are yesterday's industries, as it were, that could have repercussions as well. So-called transitional risks. I'll skip this part. It's about the digital bank licenses in Singapore. There's this whole big issue about cryptocurrencies, right? And the Bitcoin obviously is important, but that's more about private cryptocurrencies. The concern's really about money laundering as well as too quick an asset price appreciation, which then could have financial stability concerns. But from a central bank perspective, the real issue about central bank digital currencies, there are a lot of issues here in terms of, you've seen this with China, etc., but a number of issues apart from data privacy and protection. If I introduce a central bank digital currency, what is that going to mean to my conventional financial intermediaries, like my banks? So there are all these other issues that regulators have to be thinking about. So a lot of things. Sorry, I've had to run through a number of these things, but I hope you the basic takeaway is to understand that, as the title suggests, financial globalization is complex.
Thank you very much, Kishen.
Thank you.
Wonderful lecture. You've taken us from the history, going back to, I guess, what we now think of as ancient history, the Asian financial crisis, to modern versions of where we sit now. There was you began by describing the toxic combination of three things: internationalization of the financial sector, open capital account, and the absence of prudential regulation. And it's really this third arm that we have now seen an ongoing Singaporean development on, which began with a fairly controlled dual banking system with emphasis on the domestic banks, to then upscaling them, upsizing them, to now venturing into quite new areas. But again, operating on this third arm, because the first two, I guess, in our financially globalized world, we're just going to have to take as given at this point.
Absolutely.
So wonderful, wonderful lecture, giving us a panorama of both historical developments and challenges to come, as well as the successes in the Singapore system. Now, we've reached the end of our time, I'm afraid. So I'm going to have to call this to a close. That's correct. I want to thank Kishen for a wonderful lecture. I thank the audience for having tuned in. I apologize that we weren't able to get to a number of really interesting questions that had come in. I do want you to, looking ahead, I do want you to know that there's another upcoming inaugural lecture, this time by Professor Ben Kishore, the Lee Ka-shing Professor of Public Management. That will be on the 2nd of February, on Tuesday, at the same time, where he will be talking about managing COVID-19 as a super wicked problem. Lessons from and for the climate crisis. So we've got a lot of interesting developments to come, but also a lot of interesting and exciting developments that Kishen has already described for us in financial globalization. Thank you very much, Kishen, and thank you, the audience.
Thanks very much.